Look at the Australian dollar and the New Zealand dollar. Traders call them the Trans-Tasman siblings. Both are risk-on currencies, backed by commodities and firmly tied to the Asia-Pacific region. When global risk appetite rises, you'll see both of these currencies climb together against safe havens, like the Japanese yen or Swiss franc. Sharing so much economic DNA, new traders usually assume they move in lockstep. But because their economies share such a similar baseline, a small policy shift in one nation creates an immediate imbalance against the other. The true trading edge lies in hunting for the structural cracks where these two economies diverge. The primary engine driving that divergence is the interest rate differential between the two nations. On one side, you have the Reserve Bank of Australia reacting to its domestic data. On the other, the Reserve Bank of New Zealand. When one central bank raises rates to fight inflation, while the other cuts, the balance tips toward the hawkish bank. Forward guidance and inflation data predict this shift. The higher-yielding side drives the crosspair's long-term trend. Beyond interest rates, we have to look at the specific physical commodities that back each of these currencies. Australia is the world's largest exporter of iron ore. This means the Australian dollar is linked to industrial demand and infrastructure projects. New Zealand, meanwhile, relies on dairy exports. The New Zealand dollar is pegged to global agricultural needs and consumer demand for food products. Both nations count China as their largest trading partner. This data tree illustrates how Chinese economic data splits its impact. A boom in Chinese construction flows to Australian iron ore, while a spike in Chinese consumer spending funnels to New Zealand dairy. If you analyze which specific sector of the Chinese economy is currently outperforming, you gain a predictive macroeconomic bias for the entire AUD-NZD pair. Once you have that macroeconomic bias, you need to check the charts to see if the market is trending or stuck in a choppy range. We confirm a clear uptrend by verifying price action establishes higher highs, supported above a 50-period moving average. Notice the anomaly here. While price pushes to a new high, the momentum indicator below it makes a lower high. This is momentum divergence. You time your entry by waiting for these momentum indicators to correct and cross back into alignment with the overarching trend. A high-probability trade requires this specific confluence where macroeconomic data and technical momentum confirmation align. When you have a low volatility trending environment, the first execution strategy you can deploy is the carry trade. This involves buying the currency with the higher interest rate and selling the one with the lower rate, allowing you to capture the daily interest rate differential, or swap, for as long as you hold the position. The second strategy is the event-driven breakout, which is designed to exploit sudden macroeconomic shocks. Before a major central bank press conference, you map out horizontal resistance levels. If a policy surprise hits the wire, you use that immediate volatility to ride the breakout. Because AUD-NZD is a crosspair, it has lower liquidity and wider spreads than major pairs like EUR-USD. You protect your capital by using wider stop losses and adjusting your position sizing down. Mastering the Trans-Tasman cross requires moving past the myth that these currencies move together. Track the central bank and commodity divergences, wait for technical confluence, and manage your risk strictly to secure a structure.